Scott, it's strange to say that the lack of inflation is a bad thing, but it can be. Why is the Fed so concerned right now?
Well, thank you for having me this morning. And that's an important question. When we think about inflation from the Fed's perspective, what it really is a indicator of a healthy and effective economy, whereby people's payrolls, their wealth effect, their home, their real estate, their stock portfolios, their 401ks are growing at a healthy rate that's beyond the pace of inflation. So we call that real growth, or in the bond market, we'll call it real yield. So effectively, you're earning more than inflation. Therefore, you can spend a little bit more on economic growth.
So let's talk about that real yield. It's being talked about a lot these days because it's negative. Interest rates are at a certain level, and inflation, albeit low, is still outpacing some of those rates. How does that dynamic then play into what it feels like for everyday Americans and how this economy will either benefit them or be a detriment in the coming months and perhaps even years?
The situation that most investors and consumers are in now is that the savings rate for them effectively has been negative. Essentially, we've seen benchmark interest rates on safe investments, so treasuries, certificates of deposit. They've all declined significantly with a low interest rate environment globally. And as a result, what we found is that for most things people would consider a safe investment, things people would put their money in to earn a safe rate of return for their long-term savings needs, those are not earning the rate of inflation. So we call that a negative real interest rate. The challenge is that many have probably gotten used to that. And effectively what the Fed's tools have done is pushed people really out of those instruments into things like corporate bonds, where we invest in both the Core Plus and the Corporate Income Fund, for example, where others may access the markets through things like ETFs. And in some cases, even venturing into places like high yield or more esoteric or complicated fixed income strategies, because that yield number is higher.
So, Scott, you mentioned that corporate level. I mean, the Fed is active there now. I mean, they're buying corporate bonds. They're supporting the market. Is the Fed seen as being the ultimate kind of supporter of this market now? It used to be treasuries and mortgages, and now it's corporate bonds. Does that mean, despite high valuations, that you can still buy corporate bonds safely because the Fed will be there to backstop them?
We think that we can't underestimate the power that the Fed is having on the marketplace, first and foremost. But we also think that when we look at the economic data that's come out in terms of our own positioning and our strategies, it hasn't been quite as bad as originally forecast. So the market has made its peace and sort of moved on from, COVID-19, for example, as a single factor that will take the market lower. But effectively, yes, from a near-term perspective, the Fed has been injecting capital into the front end. They've been buying corporate bonds on the short-term corporate bonds and encouraging investors to push themselves out the yield curve and buy longer-dated corporate debt. That's really what the Fed's program was about, not just encouraging you to buy alongside them, but encouraging you to take the capital they're paying you for your short-term debt and buy longer-term debt so corporate America can refinance and invest in growth initiatives.